Hey, good afternoon, everybody. Dennis Mattern with Creative One. I hope you are having a fantastic, Kevin, today's Tuesday. I hope you're having a fantastic Tuesday. I would like to welcome you to our presentation of the Index Performance Review. And I'm going to introduce my colleague here in just 1 second, but a couple housekeeping items. One, if you're on this webinar, we will send you out a copy of the report. Two, if you have a question, would like to make a comment, jump in the conversation, if you look into the bottom right corner of your screen, you're going to see a robin's egg blue little box that says chat. If you click on that, if you click on chat, fair warning, everybody's going to see your name and they'll see your question. If you are feeling bashful, if you hit the Q&A box, only I see that. I will be your proxy. I will ask that question for you. And then also this is being recorded, so we can send you a copy afterwards. You can fact check us. And call shenanigans if there's shenanigans. Now, that being said, my partner in crime here today, my co-host, my friend, Kevin Cloud, our chief actuary. Kevin, welcome, sir.
Thank you much. And I strongly encourage our audience to call shenanigans on anything they see. So please, come one, come all, bring it on.
I love it. Okay, so the report itself, before we dive into it, Kevin has made some awesome additions to this report. There is nobody like this in the industry, report-wise. Kevin, there's no one like you in the industry.
There really isn't.
And I'm not going to throw any stones, but I have to say I noticed that somebody else in the industry has made a report that looks like they're kind of copying somebody.
I guess imitation, sincerest form of flattery. I was disappointed to see that, but I will note that all biases aside, I think ours remains better.
I think so too. So the reason it remains better when you get this report, one of the things you're going to see, and this is a couple things Kevin added last month, is that one, you see the index itself, the indices are listed on the left side. You're going to see the carrier that's carrying it. You're going to see if it's available, because there are one or two where they're important to track because they were so important, fundamentally.
Meaningful, yes.
Yeah. That we have the check mark there. And then the 1, 3, 12, 24, 5-year, 10-year performance. And then this is one of the cool things that Kevin had added in. Also, by the way, if you click on the name of the index, it'll take you to the landing page so you can see more performance, more information. But when you go to the right side of the screen, you're going to be able to see the internal offerings, the makeup of it, large cap, small cap bonds, and then the vol control trigger itself. Kevin, am I missing anything?
No, I think you got it, Dennis. I'll just say, we think it's a great resource. I think it's the best report out there, and we're thrilled to be able to offer it.
Awesome. And again, we are recording. If you have a question, type it in.
One quick question on this, Dennis, while we're talking about it, a question for our audience, so feel free to opine. You had mentioned that we include some indices that are no longer available. I'm curious if that's information that our audience really wants to see, or if they think that's valuable. If you're users of the report, if you look at it, do you care about some of those older indices that are no longer available? I think it's interesting. I could be alone, so I'd love to hear what our audience has to say. So if you think about it, throw us a message, and we'll consider your responses carefully. Thank you.
That's a great point, Kevin. I think it would be important because you probably have a client in there still ticking along, so you want to know. But we'll get the report out to you after this, and then we're going to dive right into the agenda. So we're going to talk index performance. We're going to take a look at some real-world returns, and then we're going to take a look at analysis. Now, Kevin, boom, we've got a big chart that just popped up for everyone that's out there. The left side of it's a three-parter, if you will, but you've got the index name, you've got the change, and that change is the gross change of the index as of close of business, May 31st, 2025. So this is 12 months looking back. You've got the gross change, and then you've got the strategy. Is it a par? Is it a cap? What is it doing? I even see trigger on there. Have we had trigger on there before? I don't think
just for a couple months.
Okay, trigger's over there on the right side. And then you see the factor. So if it's a cap, if it's a par rate, it's there. And then the actual credit. Now, question that you might be wondering is like, hey, Dennis, I see several that are zero. And you know what? What we did is, if the beauty of an indexed annuity, if it's at negative, if the index is negative, zero is your hero. So we don't credit negative returns. That's the yin and the yang of the FIA. So we just put a zero up there. Kevin, I just said lots of words.
You sure did, but they were all great. So no regrets. One thing to notice, if you've been kind enough to join us on a regular basis, you'll note that we're changing things up a little bit. So how we're going to operate going forward, again, always happy to hear feedback on this. We're going to start looking at the indices first and their credits first, and then we'll work backwards. So start with the results, then figure out the whys, the wheres, the whens, the hows. So
I
this is
like
how we're
it.
going to do things. These are the indices, as you mentioned, Dennis, and you can look very quickly and surmise which indices have had zero, indices and strategies have had zero credits, and which ones have not by looking if there's a factor available. Quite a few zeros out there. So we're actually going to do a post-mortem on not one, not two, but 3 indices this month and kind of illuminate why that might be.
Interesting. And just giving it the quick eye test, it looks like about a third had a positive return.
It's over a third.
Okay.
I would say it's approaching a half, maybe.
Love it. All right, let's dive in. Again, if you have a question and it's germane to the moment, we'll talk about it right then. If not, we'll save it to the end. Chat, everybody sees you. Q&A, only I see. I get to be your proxy. Kevin, so we're looking at, this is different. So we're looking at a couple spotlights here. Why these indices? Why now?
These are the indices that, not necessarily the indices that perform the best themselves, but the indices, when combined with an available strategy, produce the highest credits in FIAs over the trailing 12 months. These are just the customized indices. I did not include S&P 500 or gold or EFI or anything like that. These are just the custom indices. Part of, that post-mortem breaking things down is we want to look at these and understand exactly what happened. I think everyone understands what happened with the S&P 500. Mm-hmm. Let's look at what happened to some of these indices. And I think in doing that, we're going to understand not only why these indices performed or may not have performed, I think it'll add some insight into some others as well.
I love it. Do we want to stick on here, or are we just going to dive right into
No,
PIMCO?
Let's just dive right in. We're going to dive in. We're going to do PIMCO first. So to understand the PIMCO really only has 2 components. One is the S&P 500. The other is 10-year U.S. Treasury futures. Mm-hmm. That's it. So those 2 components are the only explanatory variables, both how those indices performed, then what weights were applied to them. So here's the S&P 500. Let's go over the equity component first in the PIMCO balanced index. So go ahead. So here's the S&P 500, and here's the balanced index. I mean, first of all, I think the big thing to note is the PIMCO balanced ain't moving a bunch. That's that is a steady Eddy index. And what you really know is when the balanced index was steady during those periods, and the S&P was crazy. So you can kind of look at towards the beginning of our 12-month periods, let's say around July maybe, where there was a dive in the S&P. PIMCO didn't move. When you look over the most recent 3-ish months when we saw a dive, markets, lots of volatility, uncertainty, mostly regarding tariffs. Also, PIMCO didn't move. Well, this is indexed to the S&P, or this does have a allocation to S&P 500. So what happens? So let's go ahead and look. Go to the next slide. So what we've done is for every month, we've looked and we've seen how much was allocated to the S&P 500. And I think what you'll see is...
Wait, I want to ask you.
Sure.
So is that the percentage that we're looking at underneath the months?
Yes, that is the allocation of the index to the S&P 500.
Okay, so just for clarification, and you probably were going to say this, but
No, this is good. Let's go over it.
This is very interesting, and I haven't seen these slides either. So like in June, when it's 0, you're telling me that in the month of June, the PIMCO balance 0 exposure to equity?
That's as of the end of June.
Gotcha.
But I think I had to pick my battle, so I don't want to do every day. Gotcha. So, but it's as the end of the month. So, but basically, okay. I think from June through August, effectively, there was no exposure to the S&P 500 by the balanced index. And you'll see in September, at the end of September, it started to pick some up. You'll note during September, the S&P started going up, and the index, I think, started to pick up on that as it used its rules-based engine to decide when to allocate into the S&P 500. So between September and December, there was, it was averaging about 30, maybe a little over 30% allocated to the S&P 500. And you'll note during that time, the S&P 500 was up. So that was actually really, really good. From basically the beginning of September all the way until the end of January was a highly positive S&P movement. You also note, though, that even though it was picking up and it was like getting the benefit of that allocation, it wasn't moving a ton. As a matter of fact, it was moving down some, which is really interesting. So it's not the entire explanation, but it's part of it. So you can see bits and pieces where it did pick up S&P movement. So look at the beginning of November. There was kind of a down, then an up. You see that little hump at the beginning of November. The balance index clearly picked up on that. You'll see in the middle of December, there was a down. Again, there's some reflection there. But the really cool thing is in February, especially by the end of February, and I think it's reflected in the value of the index, this was out of U.S. equities. So in February, the S&P 500 dropping like a rock. March, uncertainty, but then another big drop in the end. And from February, March, April, you saw almost no exposure to the S&P 500. So even though it was going crazy, the engine, the rules of the PIMCO Balance Index said, we want no part of this. We're staying out. And it was to the benefit of the index, which I thought was super interesting. I don't know the exact algebra behind it, like what they use to determine when they're getting in and when they're getting out.
Yeah.
But whatever that rules engine was, the PIMCO Balance nailed it. It knew it was not a great time to be in. And in May, when it was time to get back in, really middle of April, it was just starting to nose its way back in. So it did get some positive uptick from that. Not a ton though, which is interesting. But then the question is, of course, well, what we see is something that had a little bit of movement from the S&P 500, but clearly it wasn't tracking it all that closely. What was it tracking? How did it get its positive movement? Let's look at our next slide.
Fascinating.
So here's the other component of the PIMCO Balanced Index, 10-year Treasury futures. Go ahead and pop the next slide. That'll show us. Clearly, it was tracking the 10-year Treasury futures a little more closely. Not exactly, but a little more closely. What's really interesting is the index really for the entirety of the year, the 12-month period we're looking at was up just shy of 5%. Well, if you look at those first 3 months, that was effectively the entire return of the index, because you'll see from the beginning of the chart all the way over till about, there's that little plateau-looking peak in July. Pretty much all of the index return had been gained in that 3 months, which I thought was really fascinating. But it's because it was following the 10-year Treasury futures.
It's interesting, that little, let's call it October, maybe just to the left of maybe the halfway point where it crossed over. That's interesting.
Yes, that is interesting. It did cross over. That little hump is the impact. That's where you see the equity impact. So futures were down. It was still tracking futures, but equities were up, and I got a little bit of hit off that. So let's go ahead and pop the next slide, and we'll look at the allocations to.
Yeah, there it is right there.
So I think there's a few interesting points in there, but let's look at September and October. So for September, futures are mostly flat. The index itself is mostly flat, but it's 76% reflecting movements in the 10-year Treasury futures. In October, though, whatever signal it's picking up on is telling it to get out. So you notice that the 10-year Treasury futures index is dropping pretty significantly in October, but the PIMCO Balanced Index is not tracking it. It says, I don't like whatever this is. Its rules engine said it's time to get out. And so it was relatively flat in October. And then right after that in November, like we just say, that's when it crossed over, which is super fascinating to me. So it was actually outperforming for a while, partly because it knew when to get out, partly because that little hump is based on the performance that it was following in the S&P 500. But then for the rest of the year, we see some pretty significant allocations to 10-year Treasuries, and it follows it all the way along. So when I see this chart, to me, it almost looks perhaps a little unimpressive, but it's doing exactly what a volatility control index wants to do. This is a 5% level of vol control. You don't need it to perform a ton. You just need it to go up a little bit on a consistent basis to stay away from those big falls, and that's exactly what it did. So we had an index that was up just shy of 5%, but it had a participation rate in the 200 range. And so you got a credit of around 10%, which is, in my mind, this is how a volatility control index should work when it's working optimally. I think this is a really, really interesting example.
Now, with that being said,
yes,
I'm going to read you a comment. We had a participant drop a comment in here, so I'm curious. So for those of you out there, we only use one laptop when we do this presentation. So Kevin can't see. So Kevin's, if you have questions and you do want to stump Kevin, you can catch him so he doesn't have any time to think on his. He's got to think on his feet.
That's right. This is stand and deliver. You go.
Okay. So attendee said, as of today, PIMCO Balanced Index is weighted 75% to bonds.
Okay.
No way an FIA investor should be 75% in bonds. Ellipsis, if they're looking for a return. Thoughts?
I see an index right here that was allocated to, again, U.S. Treasury futures that was above 90% for 3 months and above 50% for, I think, another 6 months, just looking really closely. U.S. Treasury futures were up 5% in a very unvolatile Treasury market. So if I can get upside from that, why would I go away from bonds? I don't necessarily love it, but if I have an index that's indexed to bonds heavily and it performed, why would I be against it? I think that we're looking at the empirical evidence as otherwise. Or am I misunderstanding the question?
No, I think that's on there. I think also that's one of the things too where you really have to look at, because of something as that, and this is neophyte opinion here, but something that level, when I glance at that, I just have to assume that the options, because it's consistent, the option budget would be to where they can give a higher percentage rate, to where, if you're just at 100%, or if you're at 50% par, that might make it unattractive. But all of a sudden, if you're offering 200% par, that's something to consider for a portion.
Yes. So I would generally say if you can have an index that has low volatility and can provide a system return above zero, that is a very powerful mechanism. I think I've actually, I will admit to our audience, I've gone back and forth on this, like how much bond exposure I think is appropriate. I think that the modern technology indices that we're talking about are doing a much better job of getting in and out of bonds when it makes sense. I think this index does a pretty good job. And I think that having that exposure is actually really, really important. And I understand the need for equities, but I would say empirically we have evidence that an index that has bond exposure, and not insignificant bond exposure, can yield a really promising credit to a policyholder. So happy to have this discussion. And hey, whoever sent that question in, thank you. That is a great question.
Love it. Okay, let's go to the next one. S&P 500 futures.
Excess return.
There we go. Talk to us, Kevin.
So we're going to look at kind of two different sides of the custom index coin. This is actually pretty fascinating. These are obviously two indices. One of them, the S&P 500 futures index, standing for excess return. Mm-hmm. The other is the S&P 500 average daily risk control. I couldn't fit all those words in there, so I had to shorten it. 10% price return. So indices that are inside fixed index annuities can use two different mechanisms to kind of control option costs. One of them we're all very familiar with, volatility control. They limit the volatility of the index by mixing it with a non-volatile asset, and thereby they're able to control the volatility, which is a significant input into option costs. So by controlling volatility, you control option costs. You can dial those in pretty specifically. The other mechanism is the excess return mechanism. So the excess return mechanism basically says the performance of an index is only positive when it outperforms a risk-free rate. So risk-free rate, traditionally we thought of LIBOR, now it's SOFR. Mm-hmm. But basically the performance of the index is only positive if it's outperforming that SOFR or risk-free rate. But by doing that, you actually also can stabilize the option cost, because the two major inputs into option costs are the volatility we talked about and interest rates. By putting an excess return mechanism in that, again, you further stabilize that option cost, which is a very valuable thing. Here, what we have is we're almost able to dissect those two mechanisms, because the S&P 500 futures index does not use volatility control, but it does use an excess return mechanism. So they're not controlling volatility inside the index, but they are controlling interest. On the other hand, the S&P 500 average daily risk control 10% price return does not use the excess return mechanism, but it does use volatility control. And so we're able to see how each mechanism kind of worked inside an index side by side over the same time period, which I thought was super interesting. So let's dive into each one.
All right, interesting.
So here is the S&P 500 versus the S&P 500 futures
Right on it.
So it's very, very close, but you see over the course of the year, it slowly separates, right? Uh-huh. That's a function of the excess return mechanism, because the return of the futures index is going to be less than the underlying index, S&P 500, by roughly the risk-free rate. So you can see by the end of the year, S&P 500 is up about 14%. The futures index is up about 9%. Difference 5%. What's our risk-free rate been for the last 12 months? About 5%.
Fascinating.
So this is the S&P 500 futures, and that's how excess return works. I think this is a great example of how you can see the performance of an excess return mechanism. So I wanted to throw it in there. Huh. This ended up having a very good actual credit yield to the consumer. So as we talked about the the actual performance is around 9%. It's back on a slide a few slides ago, and I think the par rate was around 80. So I think it gave about a 7% credit to the policyholder. So,
interesting. I'm looking at I get to see the slide that's coming up. So I'm very curious to have you walk us through this, especially at the end of the year. They're fascinating.
Yeah. So I think this one is actually the more valuable of the two. This is showing us just the impact of volatility control without the excess return mechanism. This is actually an index I'm pretty fond of. This is the average daily risk control 10% price return. This is just volatility adjusted. So when things get too crazy, the average daily risk control 10% price return stops reflecting all the movement, or it doesn't reflect as much of the movement of the underlying index, the S&P 500. So you can see to the beginning of the year, we saw it track very, very closely. Then around July, we see a big departure. And then it keeps departing, but then it starts to track more closely again. You can see what looks like October. There was that little hump that we've observed before, and it followed it pretty closely. And it's following right along. And then we get into February, and we see the S&P 500 start to take a dive. The ADRC 10% PR does the same, but not nearly as much, right? So it's watching volatility. And it's kind of staying away from those crazy movements. You can see it almost actually all crosses over, just almost. And then the S&P 500 rebounds. It's still a pretty volatile period, so the risk control version isn't following all those trends. And then we get to the end of the year, and it's kind of staying out of the craziness that looks like it's around February, March, into April. And then we get to a rebound period. And I think this is one of the things that is dragging down performance of volatility control in general, and this is no great, revelation. I'm sure most people realize it, is that when there remain high volatility periods during that quick rebound, that our volatility control indices aren't basically getting back into the index or getting back in front of it, and they aren't picking up the rebound, which is a huge problem because you see an index that up through February was actually tracking pretty closely. So it looks like beginning of February, the risk control version was up about 10%. The S&P 500 itself was up 15 or 16%, tracking very closely, doing what we expect these indices to do. But then we got into a very quick down and a very quick up. And even though the risk control version was able to avoid some of those downs, because you can see it went from 10 to basically 0, whereas the S&P 500 went from up 15 to down 5. So a 20-point swing versus 10-ish swing, let's say.
Sure.
Exactly how vol control is supposed to work, it didn't get back out in front of it to capture the rebound. And I think that's one of the flaws is not the right word, but something I think we need to be aware of. We're not seeing these indices able to capture rebounds when it goes down very quickly and then up very quickly. I think in a more protracted drawdown and a more protracted rebound, the performance will be much, much better. Let's go to the next slide, because I think it'll reflect what I just said. So what I have here is volatility. Now, I'm not exactly sure if I captured the volatility that they're using for this. I think I got pretty close. I don't know if it's true.
Or what do you do?
I used, there's actually a VIX 1Y, which is 1 year volatility instead of 3 month. The VIX tracks 3 months volatility for those on the call. So I grabbed 1 year volatility, not sure what that's using. So in absolute terms, I don't know if it's correct, but I'm 100% certain in relative terms it's correct, because you can see the beginning of the year, we have that very, very low period of volatility, and the index is tracking very, very closely. And then we get to about July, in August, September, October, we see a little heightened volatility. We see some separation between the two. Volatility starts to go back down again, and we see it start to track pretty closely again. Then bam, February happens, and volatility starts to go up. The index doesn't track, and you can see kind of as we're going into March and April and May, that volatility remains elevated. So even though the index itself has started to perform again, volatility is still high, and the volatility control mechanism says it's not time to get back in yet, because again, we've got this volatility that's still elevated, so it's not capturing that rebound. Anyway, I thought that was super fascinating. This is a 10% vol control, so you might imagine a 5% vol control is going to capture is going to get back in even less. I think even though I'm just showing one index here, we have volatility control mechanisms on all the indices we're talking about for the most part. Mm-hmm. And so I think a lot of them, when there's a quick down and a quick back up, I think when there's that residual volatility, They're not able to get back in the index in time, and it's actually impairing their performance, and that's why we've been seeing the we'll call it muted performance in some of our indices.
That's fascinating. So would you say what generation of vol control indices do you think we're at in annuities? Second?
I would say third.
So you think fourth gen will have something that would address that?
They're already trying. So they're already trying to have more responsive vol. So you've seen the intraday stuff. There's a few indices I can think of 4 or 5 that have intraday types mechanisms, which are attempting to address that. Now, I don't think they're perfect because elevated vol is still elevated vol, even if you're looking at it several times a day. I think this particular volatility measure it takes. So when they're looking at the volatility that's applicable to the index, they look at the 20-day trailing vol, the 40-day trailing vol. They take the greater of the two, and that's the vol they use for the purposes of calculating the index. 40-day trailing vol. I mean, when you look 40 days ago and a quick up and a quick down, you're still going to be reflecting a lot of elevated volatility, and that kept the index in this case from capturing the upside. I think that what we see in our Gen 3 and Gen 4 indices is hopefully something that can get back in maybe a little more quickly when we see something like this. But I think this is highly explanatory.
That's good stuff.
I think that this is if you're looking for a reason why perhaps we've seen some underperformance in indices, I think this is it.
Boom, Kevin, nice. Okay, let's talk 2 years then. So same thing. Excuse me, folks. What you're looking at, wow, there's a lot of positives here though, Kevin. So what you're looking at, the index itself, the gross change of the index over the 2-year period. So this is not annualized numbers. It is the gross return, the strategy, the factor, the actual credit. But Kevin, that's got to be about 60%.
I would say it's closer to 70.
Yeah, work on my eyes. Huh?
Yeah, I know. Time to get to the ophthalmologist.
You know what? I just had an appointment yesterday, but
really?
You back it down a little bit so you don't gin it too much. Okay, so we're going to run through. So looking at it again, the index, the change, the strategy, the factor, the actual credit, and again, that is something else I do want to point out. So the report that we put out, that you put together, it is brilliant. It has the gross returns, but here when you're looking at this, when we walk through this is why this webinar is worth the price of admission. Is those are actual credited returns that your client would have got dependent upon where they're accessing this indices from. So let's talk about a couple.
Right. So I will admit I did not have time to do a postmortem on any of our 2-year indices. So you got your dollars worth during the 1 year, folks. So we'll try to get to some 2 years next time. But again, we still saw some not insubstantial credits in the 2-year space. We've seen our Schiller Barclays Global pop up quite a bit. That's a mixture of value equities along with commodities and a fixed rate sleeve. Mark V has a gold component, which certainly helped it. We all know how well gold's been doing over the last 2 years. City Aria uses has a tech-based allocation, which largely been in. So I think that's been driving that. So anyway, we'll dive into some more of these next month. We'll see where things are at on a 2-year basis and try to do some analysis on these as well. But
I would be very, I've had a couple of conversations. I got to be around a lot of our top producers, and I had a couple of conversations on 2-year resets. And I would say not positive. I don't feel like I feel like that's going to be the carriers will still offer it because things kind of go in trends. But
yes,
it feels like maybe a downtrend at the moment.
I feel like that's correct as well. I'm sure if you asked our carrier friends, they would tell you that allocations to strategies with terms longer than 1 year have been muted recently.
Yeah. Now we've been talking about those pesky treasuries. Let's talk about it.
Let's talk about some interest rates. So it's been some interesting times in interest rates. So we look at the 10-year treasury, the 2-year treasury, the 3-month treasury. 3-month treasury steady Eddie for the last 5-ish months. The U.S. Fed has, basically telegraphed the fact that they're not moving off rates unless there's a compelling reason to, and so they're kind of that rate's kind of held pretty tight. The 2-year down a little bit. I think that's in anticipation of some future economic uncertainty, maybe, and people are projecting that sometime in the next 2 to 3 years we will see that interest rate lowering. The 10-year, however, is what really interests me, because even though the 2-year has been declining, the 10-year it's fluctuated, but it's still relatively close to the level we saw almost a year ago, higher than the level we saw a year ago, almost to its peak over the last, I would say, 18 months. I think that is long-term inflation concerns and people not necessarily wanting to be tied to a 10-year fixed income security when there's a very real possibility that inflation could take off, and that U.S. debt might be not as attractive as it's been historically. So people demanding a little bit higher return on their money. So I thought I think this is really interesting. I think, we see the 3-month not moving because the Fed's not moving. We see the 2-year moving because people think it's got to move at some point, and then the 10-year is those longer term investors demanding a little bit more for their money. Yeah. I generally think this is a pretty positive graph for the fixed indexed annuity industry. We want to see that 10-year stay pretty high, and this looks really strong to me. We should continue to hope for a graph like this.
Love it. Okay, so we're going to go from treasuries to loans.
To loans.
Mark? What do you got here?
This is something I thought was fascinating. Any idea what this might be?
Loans. I'm no rocket scientist, but what is this personal? Is this
These are different types of personal loans. Yes.
Gotcha. Repayment rates, maybe?
So the opposite side. These are 90-day delinquency rates.
Interesting.
So as you'll know, as it gets over to the far right, we've seen a spike. We've seen a general upward trend, but we've seen a spike in two particular different lines of credit with regard to their 90-day delinquencies. The credit card one is the most striking. It's spiked from 8% to north of 12%. Is
that orange? Yeah.
The yellowish color.
Yikes.
Which I think there could be a lot of reasons for that. What really interested me was when I first saw that kind of alarm, I'm like, oh, is that pointing to recession? Maybe. But then you go back and look at the last time it spiked, which was during the housing crisis. However, it wasn't a leading indicator. It was a lagging indicator.
That makes sense to me.
So yeah, it was only after the thing started to go bad that we started to see credit card delinquencies go up. So maybe that's not the best leading indicator.
Oh, I see where you're going.
The other one that spiked is student loans. However, it was historically low. I'm guessing there's a lot of political, to use your word, shenanigans going on there that might have artificially lowered student loan delinquencies, and now they're kind of getting back to where they were when there perhaps wasn't quite as much easy money in the student loan forgiveness arena.
I feel like you're taking us there, but I'm really surprised that I would have thought mortgage would have been.
That's exactly where I'm going next. So when you look out like pre-2008, so look at 2006 to the beginning of 2008, you saw mortgages and home equity revolving credit start to creep up. Now it kept going up after the crisis, but it was already
like a
headed
stair
up.
Step too.
I think that's just the intervals they measured. I don't think it's.
Oh, I thought that was something. I thought I was onto something, Kevin.
Maybe you were. You have to ask someone smarter than me. You're probably right. I'll stand on that. Anyway, what I thought was interesting, we saw the mortgage and home equity revolving credit start to creep up beforehand as a leading indicator.
Yeah.
And so when I look at what we see now, we see a few things going up. Actually, everything's going up. However, mortgage and home equity are not. So I was generally quasi in the belief we might be inching into a recession, but I think the two best leading indicators of recession, at least as it, in the loan realm, mortgages and home equity credit, those aren't really moving that much. The other stuff, the consumer discretionary, definitely moving. Autos also moving. I don't know if that's super meaningful or not, but the two most important ones, mortgage, home equity credit, not the delinquencies there are pretty interesting. That could be a number of things. It could be the fact that loan standards are still a lot more stringent than they were in the 2000s. So they're keeping any bad actors out of the loan game. But I thought it was interesting. I've generally been forecasting recession in my own mind, but I thought this was maybe a counterpoint to what I've been feeling. But anyway, not necessarily directly germane to the annuity world, but still interesting nonetheless.
I think it's fascinating. Kevin, that was some brilliant, I've got to say, that was some brilliant work there. For everybody else, here's what we're going to do. We're at the end of our prepared presentation. I want to remind you, of course, that I will be pushing out a copy of this webinar. And I have to say, I'm going to timestamp it somehow, but the chart that you showed that showed volatility and the rebounding, I think that's something everybody should see. That's brilliant. I don't want to puff your ego, but that was great, Kevin.
No, I'm awesome. You're
right. Two. So the webinar is recorded. We'll push that out. I have the copy of the performance report fresh off the printer. I will fax it out to everybody. Just kidding. We'll put that out in an email PDF so you can view it that way. We do this webinar the second Tuesday of every month at 3 p.m. Central. And at this point, we do, if you do have a question, feel free to throw it in. We'll answer it right now. And another comment that got dropped in here, according to Realtor.com, 75% of existing mortgages are sub 6% rate. Thank you for rubbing that in, because we bought a house and mine is not below 6%.
Oof.
Tough. Those first world problems though, because I got a house, right? So, Kevin, we'll pause for if anyone wants to type in a question. Again, chat. Everyone sees it. Q&A only. I see it. But let's wrap with a final thought. What do you think? What are we watching? What are you keeping your eye on this next month?
Keeping my eye on just news on international trade that seems to be driving everything. I kind of wonder if the markets are become a little bit numb to it. There was a lot of what in retrospect was probably overreaction. I'm curious if we'll see underreaction going forward, as people are like, I'm not going to move on this news. Let's wait until, just someone chiming in, be it U.S. government or foreign government.
Yeah.
Maybe it won't move the needle as much.
They want to see the actual flame instead of just the smoke.
Exactly. So I wonder if we'll see, the market not taking the bait again when it comes to some of these comments. At the end of the day, though, and I think the thing to really watch is the bond market. Are we going to start seeing, movements in risk-free rates? Spreads have actually been coming down a little bit. Risk spreads on corporates and other types of debt. We'll see if that continues, if that expands all a little bit. It feels like it should a little bit, but we continue to live in interesting times, Dennis, and I'm glad for it.
We do. All right. You know what? With that being said, on behalf of Creative, on behalf of my friend Kevin Cloud sitting across from me, I would like to say thank you for taking time from your practice to spend it with us. Also, if you ever do want to take a look at performance comparisons of the indices, reach out to your sales teams. We have internal software that we use to do these comparisons and have that conversation, so that you can run through, have a conversation about why one index versus the other. But with that being said, we're going to call it a day. We will see you here next month, same time, same place. And have a great rest of your day.